Hello, everyone. This is Andrew Berman from Mortgage News One. Take two. Start that one more time. All right. The wonders of doing things live. Hi, I'm Andrew Berman with National Mortgage Professional Magazine and Mortgage News Network. Thank you for joining us for another Mortgage Leadership Outlook every day, Monday through Thursday. We meet with some of the best minds in the mortgage business, leading us through the chaos that we're going through, the crazy times that we're dealing with. So today, I am so excited to bring you Theodore Ted Tozer, who is a senior fellow at the Milken Institute Center for Financial Markets. For us, actually, you might know him. He spent 10 years at the helm at Ginnie Mae. Also was at 20 years at Nat City before that, I think even more than 20 years. And without further ado, Mr. Ted Tozer. Ted, thank you so much for joining us.
Thanks for having me, Andrew. Appreciate it.
So listen, I want to get into a little bit about, I've got a handful of questions that I've already written down that I want to ask you. But before we get into that, so for those of you that don't actually know Ted, which I'm assuming most of us do, but can you please go into a little bit actually of your bio about who is Ted Tozer, and specifically, I would love to know actually your role at the Milken Institute.
Okay, well, I guess I'll kind of start at the beginning of the time. Like I said, like you mentioned, I was at I was head of capital markets for National City Mortgage Company for 20 years prior to taking on the role of President Ginnie Mae in 2010. And again, I was president of Ginnie Mae from 2010 through to the end of the Obama administration in January of 2017. At that point, the Milken Institute contacted me about possibly becoming a fellow. At that point, Ed DeMarco was leaving the Milken Institute, where he'd gone after he left the Federal Housing Finance Agency to go to work for the Financial Services Roundtable. And they asked me to come in to kind of replace him, to work on their housing policy. Because at that point, we were going through the whole question of what was going to happen to Fannie Mae and Freddie Mac, what the role of FHA was going to be. And they asked me to come in to try to work with their housing policy group there in Washington. So again, I brought my time at capital markets, which was really critical in the fact that I dealt with Fannie and Freddie over that time period. I've dealt with other Wall Street firms in that time period, as well as my time at Ginnie Mae, where I actually worked with the government policy and so forth to kind of tie that all together at Milken, which has been great to be involved in the policy side. So,
and I want to backtrack a little bit. Because obviously, I'm really fascinated about the work actually you're doing at the Milken Institute, but we got to go back to a little history. So you have actually this great job over at National City, and you have this opportunity to become the head of actually Ginnie Mae. What led to the decision to say, hey, listen, I'm going to leave the private sector and take actually the job at Ginnie Mae?
Well, it was really an interesting kind of quirk of fate. At the end of 2008, National City was acquired by PNC during the housing crisis. And so during 2009, I was trying to figure out kind of what I was going to do since National City Mortgage was kind of being wound down with the PNC acquisition. And at that same time, I received an email saying that your name is being considered for the job of Ginnie Mae president. If you're interested, please email us a resume. And I said, why not? Again, I'm kind of for what I'm going to do. How many opportunities do you have? And they said that so I sent the resume in. The next day, I got a phone call from Secretary Donovan, Secretary of HUD's administrator, saying, when can you come in and talk to the secretary? I thought, well, that's great. I never met a cabinet secretary before. So a week later, I came in and met with him. We talked. And basically 2 weeks later, he called me and his comment was, you still want the job? I said, yeah. He said, it's yours. And that's how he offered me the job. So that's how it kind of came about. I really had no ties to the Obama campaign, no ties to the Democratic Party. It just came as an email out of the blue saying that that my name was being considered. So it was really kind of a really fortuitous situation. I was in between my career, what I was going to do, and then received this email from the White House.
That's fantastic. That's it. So yeah. Obviously, you always take an opportunity like that, amazing opportunity. So, and now traditionally, that role was not filled by someone who had decades of experience in the industry, especially someone actually had decades of industry in the industry in the capital markets. So, what led to the decision for them to say, "Hey, listen, we need someone actually, from the industry to kind of help us through this mess"?
Truthfully, I really know. All I can really go by is Secretary Donovan mentioned to me during the interview process that he had gone to a number of industry people in different aspects of the housing industry to kind of get a short list of people he should pursue for the job. And he told me that he's glad I came in because he said the interesting about it was since he had people from all different aspects, community groups, trade groups, I was everybody's list. So he said nobody else was on everybody's list. So he's glad I came in. So again, it just seemed like Secretary Donovan really wanted to try to get somebody outside the political, ecosystem in Washington, the way he reached out to these different groups to try to get a short list on who he should approach.
So when you got into the position there, what was the state of Ginnie Mae? Was it handed over to you and you needed to do a lot of work? What was the state that Ginnie Mae was handed to you?
Well, it's kind of unique. I was in a very, very unique situation in the fact that Ginnie Mae or National City, we were basically one of the top 5 Ginnie Mae issuers in the country. At some point, we were number 1. So I knew all the Ginnie Mae staff. I'd known them for years. I'd been chairman of the Capital Markets Committee, the Mortgage Bank Association, and so I'd worked with them at that point. So at that point, it was kind of a known quantity to them, and they knew me. And they knew the things that I wanted to try to get done because they knew as being an issuer, the things I had kind of pushed them to try to accomplish to try to make Ginnie Mae more customer-centric and more effective. And so to me, it just kind of helped in the fact that I did come to the industry. They knew me and was able to hit the ground running. But what I found there was that it was an organization that really didn't have a lot of confidence in itself. They'd really been a second fiddle to FHA and other people within HUD. People didn't know what they did. And even to some degree, I don't think the Ginnie Mae people really appreciated 100% even what they did. I mean, they were so caught up in the day-to-day operation, they really couldn't see the big picture, how they fit into the whole industry. So I think I helped them understand it because nobody at Ginnie Mae, when I got there, it actually worked in the private sector. They all were career HUD employees. And so because of that, they didn't really understand how Ginnie Mae really impacted the servicers, issuers, the borrowers. So I was able to help them with that.
Wow. That's was it challenging? What was that like? Or were they receptive? Were they embracing, or were you met a lot of opposition?
I think it was kind of a combination. I mean, you have people that really were excited about it. Some people didn't like it, and the fact that we were trying to move forward and really try to make the Ginnie Mae more accountable to the issuers and industry and so forth. So because we had a lot of turnover, I mean, basically. Within the first year or so, we probably had maybe half the people who were there when I got there, probably a year to 2 years later, were gone. Wow. Because the idea that they saw what we were trying to accomplish. So we had really 2 camps. We had one group that was really excited and they really couldn't wait, that they really saw the vision and they really bought into it. And the other half were like, wow, I'm old enough to retire. I'll take a retirement because that's what we had at Ginnie. We had a lot of people that were actually retirement eligible. And they decided to take their retirement. So, but with that, I think right now Ginnie Mae has probably, an incredible staff there. So even though they really haven't replaced the president and have a confirmed president, the staff there is probably top notch. I think I would put Ginnie Mae's staff up against any other agency in the government right now because we have a vision. People are excited. They see what we were accomplishing, and they really bought into it. And even though their pay wasn't the best. Ginnie Mae was a place to come work in the federal government because they knew what we were doing, where we really were making a difference. We weren't just, just coming in punching a clock. We really were making a difference.
Yeah, and you could see actually there was so much more outreach that was done actually. When you took over the reins there, it was like it's like you were operating like a business, not like a government agency. So Joe Berman, my father, also someone I know who you've spent time with. So he said this: during your reign at Ginnie Mae, you took a small team that witnessed an enormous growth in securitizations and delivered, despite working with antiquated and legacy systems. How did you do that, and how is that prepared? How do you think that's prepared Ginnie Mae to assist in the current environment?
Well, the biggest thing we did was we were lucky. I mean, I was ecstatic. I would think that Ginnie Mae's IT staff is probably one of the best. I mean, it's better than anything HUD's got. I mean, I was so lucky to get the people I got. The person who runs our securitization platform ran a big chunk of the securitization platform, Freddie Mac. Again, he came over because he wanted to get away from all the Freddie Mac bureaucracy. He wanted to come to a place he can make a difference. So he came over. Our chief information officer had worked at Fannie Mae, then worked for the Fed down in Richmond, because Richmond's where the Fed's databases are all based at, and the commute was too long for her. So she came to work for us. So and the database architect at Ginnie Mae worked for Fannie Mae's database management. So the people we have on the IT side are second to none. The hardware architect we have worked for the Washington D.C. Police Department, running all their IT. And again, he liked the bureaucracy. He liked the excitement of coming to Ginnie Mae. We get things done, and bureaucracy was not going to back you up. So because that my time period at Ginnie Mae, we went from a system that was based on mainframe technology to now Ginnie Mae's whole structure is a client-server basis. Everything is now is basically 21st century technology. I was able to work with the Office of Management Budget, who had to sign off on our IT budget, and they bought in 100% we were trying to do. So we spent hundreds of millions of dollars at the time I was there, actually revamping the whole technology to the point now where Ginnie Mae's disclosures are actually looked at to being more superior than what Fannie and Freddie do. A lot of it in our technology is actually because we were able to actually build a system when we were small. I mean, our issue was our database was small, so it's easy to move to a new system. We don't have a lot of legacy issues. Fannie and Freddie are so big, they would not be able to keep up with us as far as what Ginnie Mae's done with technology, because we were able to grow the technology as we were growing the database. So now it's a situation now where for Ginnie Mae to grow, it's not a big deal. You just put another server on the system, and you can move forward. It's all easy to grow, and the database is now it's not running COBOL, whatever things you have to make change. Like when I got to Ginnie Mae, they had to make their pool numbers alphanumeric. They're running out of pool numbers. That process took like 9 months to change the technology so you'd put an alphanumeric value in pool number. Now they can make changes like that in a day.
Wow. So just give us an idea. When you started at Ginnie Mae, how many issuers were there in total?
Well, the number of issuers we had probably were not much different than it is today. The difference was when I came to Ginnie Mae, there was there's like 6 issuers that made up maybe 70% of the business. You had Bank of America, which is the old Countrywide. You had Chase. You had Wells Fargo. You had a GMAC Bank. You had U.S. Bank. Those guys were 2/3 to 3/4 of the business that Ginnie Mae did. Today, there's no bank that's even in the. I think Wells Fargo might be in the top 10, but that's about it. So the big difference was the shift. Like for example, Quicken wasn't even a Ginnie Mae issuer when I came to Ginnie Mae. They sold all their loans to Bank of America when I got to Ginnie Mae. People like Penny Mac didn't exist. People like Lakeview didn't exist. So the difference is what I saw. It's the shift in the complexion in the composition of the business. It's not so much the number of issuers.
Interesting. So just more sparsely spread out and completely different players. So listen, let's go fast forward to today. Or not today. Let's fast forward to February. So February, you're at the conference, the Americatalyst conference. It's like with superstars in the real estate finance world. So talk to us a little bit about what was happening at that conference, and how actually there was some conversations there that kind of almost impact what we're doing today, or talking about actually, how we're dealing with the liquidity crisis that we face today.
Yeah, I mean, one of the things we talked about in our cast, we had a couple of panels on, was the question of the challenges that input mortgage bankers would face if there was a major downturn in the economy, which would force up delinquencies, and how they were positioning themselves from a standpoint of balance sheet, funding, and how they could work with that. So again, that's exactly what we're talking about now. You saw the discussions with, should the Fed open up a liquidity source for the servicers. Those are all things we talked about in Dallas at the Market Catalyst, because that was one of the things we talked about, is how we could deal with it, since independent mortgage bankers, when it comes to the Ginnie Mae side of the business now, makes up probably 75-80% of their new business, and the Fannie Freddie side is probably 50-55% of their business. They're the backbone of mortgage banking. It's not the banks anymore. And not having the liquidity sources that the banks have, we're almost back to a 1930s situation before we built all these protections in for the banks during the Great Depression. We're the same situation now with independent mortgage bankers, that there is no backstop to them as far as liquidity.
Interesting. So what's what's the solution? How do we address this? If we could have better prepared for COVID-19, what would have put us in a better position?
Well, it's not so much COVID-19, but again, it's just the issue we were talking about. Was the financial downturn, which would have pushed up delinquencies to incredible amounts. Like in 2009, people kept asking me, why in 2009-10, why wasn't Ginnie Mae or wasn't ICE complaining about this issue with the economic downturn? It's because, like I mentioned before, with these banks that held virtually all the Ginnie Mae servicing, so they had plenty of cash, they had plenty of deposits to cover it, and that's what's changed. So I think the issue we need to look at is, do we basically allow, for example, independent mortgage bankers to become for example, like American Express or Discover, but actually able to do online deposits that are guaranteed by the FDIC, because that's really all they do, is really credit card operation, and they're basically raising deposits to fund their credit card. So we do the same thing with independent mortgage bankers. Some people talked about giving them access to the Federal Home Bank System to borrow if they get into financial difficulty. So I think these are all things we need to discuss. How do we actually look at it, knowing that independent mortgage bankers are probably not going to kind of reduce their position, because I just don't see banks coming back in a big way anytime soon, which means the mortgage banking can be dominated by these truly private sector companies that don't have any kind of government support at all.
Wow. So it's kind of like now what could happen? I mean, could we see where we lose products, we lose what could be the end result? If nothing was done.
Well, again, it depends on how bad it gets. But it really got delinquencies for a sustained period of time and really high levels. You probably could very well see a reduction in the amount of FHA and VA lending, and the amount of lending to people with, let's say, a little bit lower credit scores, a little bit higher debt-to-income ratios, that the banks really feel uncomfortable lending to. Because right now, the independent mortgage bankers, and when I was at Ginnie Mae, I talked to people at Treasury. They were doing some research when I brought this up, and they were saying that independent mortgage bankers were very good at servicing. They were very good at dealing with defaulted borrowers, a lot better than the banks. So they feel comfortable taking on some of these more weaker, credit borrowers, where the banks really were uncomfortable knowing that if they borrow in delinquency, they probably are going to have a tough time really doing a good job of really servicing their customer the way they should. So because of that, you could have those kind of borrowers kind of being left out from the marketplace, if independent mortgage bankers felt that they had to pull back and not be as aggressive in the industry because they were trying to hold cash for other needs. Because the issue we have is independent servicers in the Ginnie Mae program, in the Fannie Mae program, you're required to advance your delinquent payments to bondholders. So if you have a borrower that's delinquent, and it's for extended period of time, you're going to have to make those payments to the bond holder. You're also going to have to make their escrow payments as far as tax, insurance, MI, mortgage insurance, the premiums to FHA, all of your corporate money, as well as you're not going to get the revenue from your servicing fee because they get paid out of the payment the borrower makes. That's how the servicer gets paid to actually collect the payments. So if your delinquencies go to, let's say, 20, 25%, that's a huge loss of revenue when you need that to cover these costs of delinquencies.
Yeah. So fortunately, there is at least some government assistance when it comes to government-backed loans, but when it comes to private labeled securities, let's kind of shift gears, kind of talk a little bit about private label securities, because this is what actually we connected on. I saw you participated in that report with Milken Institute. So talk to us. Well, why is self-governance important in the private label securities industry to address the forbearance issues that were impacted by COVID-19?
Well, it's because it's a situation where you've got to be able to have a system that responds to the situations that are affecting the consumer. You got to be able to deal with things like forbearance. You got to deal with things like having refinances that are available to people that may not have a lot of equity in their home. All those kind of issues. And the problem you're running into is if you don't have that, the political people are going to deal with it. They're going to find a way to get those things to be done for the consumer. Because if you're a consumer and you're in a situation where you have a mortgage, you don't know who owns your mortgage. You don't know if it's a PLS structure, if it's Fannie or Freddie. You don't know, Ginnie Mae. So for you to get a different response than your neighbor got, that's going to cause tremendous backlog issues. So my feeling is the industry needs to come up with a way that their system is flexible and be able to deal with this economic situations so they can deal with that, so that the politicians won't tell you how to do it. Because I'll tell you, from my time in Washington, the politicians do not know as much as you know in the industry. So if you're going to leave it to them to tell you what to do, you're probably going to be in really, really bad shape. So that what you need to do is you need to have the leadership and say, this is what we're going to do to protect the consumer, to make sure what's happening. Because I saw it firsthand in 2011 when I was working to try to revamp the HARP program, which was the refinance program that came out. So if a person had really high LTVs, they lost some income, they still could refinance their loan. The problem we ran into is everybody except for PLS would do it because they all were able to structure it because FHA said, we got the credit risk. What's the big deal? Fannie Freddie said, we got the credit risk. What's the big deal already? What's the big deal? They came to PLS. We couldn't do it. So everybody was able to participate in HARP except for the PLS because PLS was so inflexible. And I always tell people, I always felt like I played God because when I was at National City Capital Markets, we would look at each individual loan that was made and we would determine where we could sell it for the best price. So sometimes I had loans that were originated to Fannie and Freddie guidelines that I put in PLS deals. And I had loans that were set for PLS that I sold to Fannie and Freddie. So at the end of the day, there were even borrowers and originators that didn't know where their loans went. And I really feel bad about that because anybody I put into a Ginnie Mae or Fannie Freddie security, they were great with HARP. But anybody who lost out and went to PLS, they were stuck. And that's what's really hitting me in the fact that PLS has got to evolve. It's got to become more flexible because PLS is designed for the fact that everything runs perfectly. Yeah. You have maybe a small amount of foreclosures, everybody makes their payments. But the problem is once that doesn't work, the whole system falls apart. And that's what we're trying to get across in the paper is the PLS process is so cumbersome and it's so complicated that it really makes it really difficult, but they got to find a way to get it to work. Because if they don't, the consumers are going to make life miserable on the politicians. And you're seeing it because in this last bill that came through on the CARES 4 for the Democrats on this $3 trillion bill, in their mandates, the PLS will give forbearance because they didn't have anything. Now Congress is telling them they got to do it. So that's what happened. So now it's coming. They haven't told you how to do it, but they're just telling you got to treat everybody the same. So every consumer walks into a lender, it's got to basically be treated the same way when it comes to forbearance now. If this new COVID legislation passes.
Okay, so Okay, so that's not going to work. So what do we do? Like, where's the solution from, being able to do, the forbearance? I mean, we still actually, the bondholders are still going to want their money. So we can't, like, that's not going to change.
Right.
So how can we, self-regulate? How can we come up with, actually, as an industry, come up with our own solution before the government throws down the solution down our throats?
Well, to me personally, I think what I've seen over in my career is that the PLS market has almost devolved. I mean, it's almost gotten taken over by the attorneys, and the technicians don't run it anymore. When I first started dealing with PLS back in the 1990s at National City, the issuers would hire a master servicer, be very similar to Fannie and Freddie. They would give you a servicing guide that told you how to service. You had questions, you would have somebody, and that person was an intermediary between you and the bondholders. They could actually work these things through and determine how you get it to work. But by the time we got to 2005, 2006, the heyday of PLS, we had these what they call purchase and sale agreements that everyone was different. These attorneys had put their own spins on it. There was no seller servicer guides. There was no ability to change the servicing requirements as the market changed. It became very, very, again, tied by the attorneys. It was these huge documents that were, hundreds of pages long that you had to deal with versus having a standardized servicing agreement and guides that we had back 10 years earlier. And I think we need to get back to that, where the industry kind of agrees this is kind of the servicing standard, and this is the kind of who's going to keep evolving those servicing standards depending on what happens to the marketplace, and not have what I would call I would almost call it like a dead agreement where it doesn't change. It's not living and breathing. The PSA agreement was done with no ability for it to be amended, to be changed, or anything. As the market changes, we need to have something that's more like we have a Fannie Freddie seller servicer guide. I would like to see that, and that way the industry would become a lot more liquid. Because without that, the PLS can never replace Fannie and Freddie. Think where we'd be at today if all of a sudden the PLS was a major player and we couldn't do forbearance because of all these issues you put in the paper. Yeah. So until they get this fixed, PLS has to realize that it can't be anything more than very much a asterisk for the mortgage business, because it can't be the main player, because there's too much at risk if the Fed can't, for example, put monetary policy through by dropping interest rates and hoping people can refinance. Like we did in 2010, 11, and 12. That wouldn't have worked. If everything is PLS, rates would have fallen, but the PLS borrowers couldn't refinance. So the Fed dropping interest rates would not have been able to be as effective as what we saw. So that's the reason why I think this has got to be dealt with.
Yeah, I mean, just think of it. If the QM patch expired and we were dealing with after that, that could create a recipe for disaster. So all right, so let's walk us through the worst case scenario. Like, walk us through actually so we now actually private labeled securities has to honor the same forbearance that government backed loans, and there's no liquidity issue, there's no liquidity facility for those private labeled securities. What is that worst case scenario? I mean, we're already talking about all sorts of doomsday scenario. Might as well get us even more depressed, Ed.
well, the nice thing about it is the private label security side never really took off. So it's not like it's really going to affect the servicers that much more, because their exposure to advancing and so forth is going to be more pronounced on the Fannie and the Ginnie side than PLS. The biggest issue I see is having this situation where a servicer does forbearance. Then the question is how the rate agencies deal with that forbearance. Is it delinquency or not? Like we saw in the paper, we wrote in the paper, is delinquency or not? How does it affect how the cash flows? Is it actually be charged against the subordinate bondholders, or how does it all work? Well, now we got to figure that all out, because now the question is, it's here. So now we have to figure, what does it mean for forbearance, and how does it work, and what do the servicers do when the forbearance period ends? Do they tack on the end of the loan, like Fannie and Freddie are now saying that they can do, or do they make the borrower pay it all up front? I mean, how does that all work? And the idea that if you put at the end of the loan, then again, what does that do to the bondholders and so forth from that perspective? So that's all we need to work this out, because everything in the paper now has become reality, all the, as we call it, the tranche warfare, as far as the different tranches of credit risk, is going to start, because now if this legislation passes, they're going to have to deal with it, because loans are going to go into forbearance. And then how do you deal with it without having any plan in place?
So, I mean, I've always assumed that you cannot, hold back payments to bondholders, because that as soon as you do that, you're destroying the credit rating. And it's my always assumption that that's never been an option.
Well, again, but on private label, in some ways, it is an option in the fact that basically the PLS, as I understand, when I was at National City, is the PLS agreement states that as long as you think that your advance is recoverable, you have to advance it. Once you feel like they're not recoverable, then that's when you saw in 2009, 10, PLS bonds getting downrated, because they got downgraded because the money wasn't coming through. So it's not like a Ginnie Mae or Fannie or Freddie where somebody's guaranteeing the bondholder payment.
Yeah.
The question we're into with this is when the monies don't come through, do you charge 100% against the subordinate bondholders? Do the AAA guys, take some of the charge? I mean, all that becomes, I think, the whole question of how you allocate these losses between the various subordinate bonds. And again, from the service perspective, what's the definition of what's collectible? I mean, if it truly is a situation where the consumer believes they're going to go back to work in 6 months, then does that mean that you have to keep advancing? Or does that mean that once you get to a certain point, you don't have to advance anymore? Kind of what Fannie and Freddie are doing now with their 4 months, and at that point, you don't have to advance anymore. So those are all the questions that have to be dealt with, is giving servicers direction, as well as the trustees, on how to deal with all the payments that come through or the lack of payments that come through from the servicers.
Wow. So let's go back. Let's go back. Maybe was forbearance not the right thing to do? Like, should we have actually set up and said, "Hey, listen, we need, everything needs to be looked on a case by case basis. You need to prove hardship." I mean, if we can, pause and rewind and go back to that day, would you have suggested other solutions besides, no documenting of forbearance, for anyone who applies for it?
I would say the reason I say no is I don't know how the services could have processed it. You have to realize, look how quickly unemployment's gone up. We basically went from, it took a year to get to the high point of unemployment during the Great Recession. We've gotten to this point in 6 weeks. So I don't know any servicers that could have literally processed millions of, as far as in its area, or each individual servicer, tens of hundreds of thousands of potential borrowers coming in and asking for information and trying to get through it all, ask questions, get back to them. I don't know how you could have kept up with it. It would have been a train wreck, because of the fact that this unemployment has come so quickly. Plus, this unemployment is so strange in the fact that normally we have these situations, it's because consumer demand has gone away and we have too much supply. So we lay people off because we don't make any more widgets in the factory because the fact that nobody's buying it. That's not the situation today. The situation today is nobody's working at the factory because they're scared to go work at the factory. Yeah. So the question is going to be is they're going to be hired back. So that's the reason why you hate to go start the foreclosure process, is if in fact in 4 or 5, 6 months, the borrowers can right back to their old job. And at that point, why disrupt their families, cause community problems with all the foreclosures? So I think the forbearance makes a lot of sense. Yeah. My frustration is that the PLS didn't have the flexibility to evolve, because there's no way they could have seen this coming when these contracts are written, 5, 6, 10 years ago. But there's no ability for it to evolve with the current environment. And that's where the problem is I see with the PLS market and forbearance. But I think forbearance, I can't see any other option besides what Congress did with the forbearance issue.
Interesting. So wow, that's a powerful thing. So if it's left up to the private label securities, and they're just giving their own solution and they can do whatever they want. What do you think actually most of actually, and not just you, I'm just talking about the industry overall. It's not just your personal opinion. What does the industry feel that they should be doing as actually, the way to address self-governance?
I don't know. The industry has tried ever since the Great Recession. I mean, they've had all these different structures as far as trying to come up with some sort of a standardized process, and they can't seem to get there because everybody kind of goes their own direction. Everybody has their own positions on kind of where it needs to go. It's like anything else. Everybody's got their own spin on where they saw things breaking down, like the Great Recession. Well, the problem is now this needs to be a wake-up call. If you're going to try to make this thing perfect, it's never going to happen. But you're being left out in the cold because you can't live with perfection. You got to live with something that gets you 85, 90% of the way there. And I think that's hopefully where wake-up call it's going to happen with the industry to actually sit down and say, okay, what can I live with? Not what's perfect, but what can I live with?
Yeah. Wow. Not, is there any bright spots that you see that you're looking forward to? Anything actually, positive that you see in terms of housing or liquidity? There's so much uncertainty as far as, when do we when do we get released from our lockdown? When's there vaccination? But anything you could share actually that you feel positive about?
Oh, I mean, right now, housing, I'm very positive about it in a lot of different ways. First of all, it seems like home sales are hanging in there. People still are buying houses. So with them buying houses, home prices are still continuing to go up. This is a complete difference from the Great Recession where we had oversupply and home prices were falling. This one here, we still have more people buying than are selling. We're in a situation where rates as low as they are, people are refinancing like crazy, and they're able to get lower payments, which is enabling them to have lower mortgage payments, which helps them to have less money that they're obligated to make every month. Because there's such an incredible amount of volume, mortgage bankers, like any kind of supply and demand imbalance, they're able to make a little bit more money, profitability on these transactions. Yeah. Well, then again, that's helping liquidity because the more money they make, the more cash you're generating. So that's helping out the liquidity side. So in reality, I think in reality, I'm really excited the fact that PLS never took off, because that's probably the one area that probably has the most issues at it, but it's such a minor part of the market right now that it really has helped. Because if we would have done what some of the aggression Republicans wanted and wanted to shut down Fannie and Freddie, a PLS take over the whole world 10 years ago, we would really be in a whole different world right now. Because with Fannie, Freddie, Ginnie Mae, FHA, and VA being able to kind of set policy and be able to be a kind of a control kind of what's going on, because everything flows through them, it's enabled the market to respond effectively to the consumer's needs, and in the short period of time. I mean, again, it's just mind-blowing to think that 60, 90 days ago, people, I remember I was at a meeting back in February, and they were laughing at the mayor of San Francisco because she was declaring a COVID-19 national emergency. They were saying that she was just literally trying to cause all kinds of panic. Well, here we are today. So that's much it's changed, and to have the housing market in good a shape as it is today, with this kind of a change in the whole economy, is really, I think, a tremendous positive to show how well the housing market works in the United States.
Yeah, I think other than Jay Farmer and my wife, there was no one talking about actually this being something that was going to impact us as it has. So that's listen. It is great to see housing doing great. It's great to see the technology that's quickly gone into place. Emergency legislation that's gone into place to allow actually us to continue to exist and grow and continue to get housing to prop us up and bring us out of this mess here. So. Ted, I really, really appreciate you taking the time to meet with us. I know you're very busy actually with lots of things. So I really, really appreciate it. Thank you so much for joining us today, Ted.
Thank you. Appreciate it. Thanks for being here. Appreciate it.
All right, everyone. Thank you so much for joining us for another Mortgage Leadership Outlook. So excited. Again, we do this every day, Monday through Thursday, 4 o'clock Eastern time, 1 o'clock Pacific time. Next week, we're starting off the week with Angel Oaks, Tom Hutchins. So excited to have Tom Hutchins come back. And then on Tuesday, Jeffrey Tesh from RCN is going to be joining us. Wednesday, Eddie Perez from Equity Prime. Wrapping up the week next week is going to be Thursday with Martin Warren from Nations Direct. Everyone, thank you so much for joining us. Please stay safe out there, and we will see you next week.